We have main engine start. 4, 3, 2, 1.
28th of January 1986, 11:39 a.m. The Challenger space shuttle takes off from Kennedy Space Center. Millions around the world were watching live as the schoolteacher Krista McAuliffe, who had been chosen from 11,000 applicants, became the first civilian passenger of the space shuttle. But just 73 seconds into its flight, disaster struck. With the world watching, the shuttle exploded, tragically killing everyone on board. There were different rumours about what caused the explosion, but it was months until anyone knew the facts about what happened. There were 4 major companies associated with the shuttle program that were potentially on the hook. Lockheed, which managed ground support, Martin Marietta, which manufactured the external fuel tank, Morton Thiokol, which built the booster rocket, and Rockwell International, which built the shuttle and main engines. The Rogers Commission, ordered by President Reagan, began investigating. The most famous moment came when Nobel Prize-winning physicist Richard Feynman gave a demonstration showing how the O-rings used in the solid rocket booster were catastrophically flawed. These were found to be the point of failure, and after 5 months the conclusion was clear. The fault lay with Morton Thiokol. In 1998, 12 years after the tragedy, the economists Michael Maloney and J. Harold Mulherin published a paper called The Stock Price Reaction to the Challenger Crash. They set out to discover the reaction in the stock market to the companies involved. They said, "We study an event in which investor panic could easily lead to initial overreaction, and because the government investigation of the cause of the crash took 5 months, one might expect a delayed stock market reaction to the crash." So how long did they find it took the market to price in this disaster? Days, weeks, months? It was within 21 minutes. Not 21 minutes after the conclusion of the Rogers Commission, within 21 minutes of the explosion itself. All 4 companies saw an initial drop in their share price, but the 3 companies that were not at fault saw much lower volumes and smaller declines that were more in line with what was statistically normal for them on a regular day. Morton Thiokol, on the other hand, saw huge volumes of selling. By 11:52 a.m, the NYSE halted trading on Morton Thiokol because the order flow overwhelms their exchange systems. Once it continued trading, it was down by 6%, and by the end of the day, it had dropped 12%. There were no signs of insider trading, no information was being released by the companies involved, yet Morton Thiokol, in the eyes of the market, was clearly singled out to be the company that was on the hook. Amazingly, the lasting decline in their market cap of $200 million was around the same amount as their eventual damages, settlements, and lost future cash flows. This remarkable situation highlights a powerful phenomenon known as the wisdom of the crowd, the unbelievable accuracy that comes from the combined knowledge, analysis, and intuition of thousands of experts motivated by self-interest to focus on a single objective. This powerful concept is overlooked and underestimated by most traders, leading to the biggest mistake that traders and investors make when using fundamental analysis. They confuse having an opinion with having an opportunity. Let's break that down. Imagine this, there's an FOMC meeting coming up, so thinking there's a potential opportunity, you start digging into the financial news and analyst research. After a few hours, you decide that you think it's quite likely the Federal Reserve will cut rates. And for a further confidence boost, you keep reading that the market believes there's a 75% chance for a rate cut. So the chance of it happening seems to be quite high. You connect the dots, lower interest rates means a weaker dollar, so you do your technical analysis, find an entry, and short the dollar. The trade is open, your confidence is high because you've backed up your technicals with fundamentals, and now you just have to wait for the FOMC announcement. Congratulations, you've just made a mistake. Why? Because you only figured out what you think is going to happen, but not whether it's an opportunity. And yet, on social media, you'll see traders bragging about this exact approach all the time. I saw the Fed was cutting rates, so I shorted the dollar and made a profit. Look how smart I am. And the comments go wild. Teach me how to trade fundamentals. But what they won't tell you is this. They got lucky. And luck is not a great strategy. So here's what's wrong with that approach. One of the foundational principles of the markets is that all available information, including information about future events, like an upcoming FOMC meeting, is reflected in the current price. That's a key idea of the efficient markets hypothesis. And while the EMH has many flaws, this part holds true most of the time. So does the market always get it right? No, of course not. But as the Challenger space shuttle example shows us, the market's collective intelligence is often far more accurate and far more impressive than we tend to give it credit for. A lot of traders like to make out like the markets are stupid and they're always getting things wrong, as if they're somehow superior to the markets as a whole. But here's the truth. If you want to profit from fundamentals or from trading in general, you need to understand this. The market is incredibly intelligent. Assuming the market is wrong is just a recipe for disaster. It's much better to always have the position that the market's probably right most of the time. So in that case, if you're opening a trade, you need to ask yourself, what is it that I'm seeing that thousands of experts are not? But you might be thinking, yeah, but opening a trade doesn't mean that I'm seeing something that the market isn't. For example, whenever the market is pricing in a rate cut and then a rate cut does happen, you still see the market reacting to it. And yes, that's true, but there are a number of reasons for that. A big reason is that when something's priced in, we can think of it as being priced in as a probability. So for example, the 75% expectation that I referred to in our example is usually derived from the markets in the first place. So let me show you what this means with a simple example. Let's say that we're analyzing an asset that's currently priced at $100, but then suddenly out of the blue, there's an economic event that's announced that's 1 week away. And there are two possible outcomes of that event, outcome A or outcome B. If outcome A happens, the asset will be repriced to $110. If outcome B happens, the asset will stay at $100 because it means there's no change to the underlying value. Now, if before the event, the price actually starts drifting up and it reaches $107.50, with all else being equal, we might say that now what's being priced in is a 75% chance of outcome A. So from this point onwards, there's a 75% chance of a further gain of $2.50 and a 25% chance of a loss of $7.50. So if you, as the trader, also agreed that the probability was 75%, and so you decided to enter a long trade, you'd have no edge at all. Your probability estimate is aligned with the base rate. Now, the chances are for this individual trade, you will make a $2.50 profit because there's a 75% chance of that happening. But if you trade like this over and over again, over time, you'll just end up at break even because you have no edge. So what now? Does this mean I'm saying we should just give up on fundamental analysis? No, not at all. In fact, some of my biggest trades, life-changing ones, have come as a result of fundamentals and then finding the entry point with technicals. But the thing is, to profit from fundamental analysis, you need to understand what creates an opportunity in the first place. And I believe there are three broad ways. Having information no one else has, having rare expertise in the relevant area, or having a better estimate of probabilities. Now, let me save you some time, Gordon Gekko. The first option isn't viable unless you enjoy spending time behind bars. Why? Because it's called insider trading and it's illegal, unless of course you're a member of Congress. The next option is to be among a small minority of experts in a relevant field. So imagine this. You're the world's leading expert on lithium hexafluorophosphate. That is a bit of a mouthful to say. It's a compound that's used in lithium-ion batteries. One day, a car manufacturer announces a revolutionary new electric car with record-breaking battery life using that particular compound. They've discovered this secret and the market goes wild and the stock price soars. But you, the world-leading expert, know something that the rest of the market doesn't know. You know that this particular compound degrades rapidly in cold weather. Not only because you've seen the tests, but because you were the person who ran the tests. You crunched the numbers. You know that failures and recalls are inevitable. So while the market buys into the hype, you start shorting the stock. The result? Massive profits. But just like the market in that example, let's get ourselves firmly back to reality. Building this level of expertise takes years, if not decades, and it's going to be limited to specific niches. Most traders don't have and will never have that kind of edge or the opportunity to use it. So that brings us on to the final and most practical way to find opportunities with fundamental analysis, which is to have better probability estimates than the market. So let's go back to our example. If the market has priced in a 75% probability, we can call that the base rate. So the base rate is a 75% chance of a $2.50 move and a 25% chance of a $7.50 move. That's break even. But you've done extensive research. You've analysed all the data, you've watched all the speeches of people involved in the event and used AI to pick up on body language nuances, and you're very, very sure the probabilities are actually a 60% chance of outcome A and a 40% chance of outcome B. So your probabilities are different to what's currently priced in. You agree with the market that outcome A is more likely, but the viable trade for you right now is to go short rather than going long. Why? Because if your probabilities are right, it means the market is mispricing the event. So by going short, it means you have a 40% probability of a $7.50 profit and a 60% probability of a $2.50 loss, meaning the expectancy would be $1.50. So in this situation, if you just did what most traders do and thought to yourself, okay, it's likely to be outcome A, so I should go long, without even realizing it, you would have been taking a negative expectancy trade. And if you keep taking trades like that over and over again, over time, you're going to lose money. It's only by quantifying your prediction about what you think is going to happen and explicitly stating the probabilities that you would have realized that the market has gone too far in pricing in the event and the opportunity is to be contrarian. You see, the wisdom of crowds is amazing. Over time, across all these different events and all these things that take place, on average, the market will get it right. Some of those times will be remarkable, uncannily accurate predictions like the Challenger disaster. But also part of that average will be times where it isn't accurate at all. So when you do your analysis and quantify your conclusions, you might decide you're not confident enough to go against what the market suggests. Or you might see that your expectation matches what's already priced in. But every now and then, you'll pick up on something that you think the market hasn't got quite right. And those opportunities can be absolutely huge. If you want to understand more about this way of approaching things in the markets, which I honestly believe is the most professional and most dependable way, check out the free training that's linked in the description box that goes into much more detail for both technical analysis and fundamental analysis, or watch one of these videos that are linked on screen next that will help improve your trading dramatically by starting to use probabilities.